Hello guys, welcome. This is Deepika from wealthandhealthmastery.com. In this video, we are going to take a look at Undervalue growth stock, and we are going to see if this stock is good buying opportunity at the moment or not. We are going to do a full stock analysis looking at the earnings, PE ratios, PS ratios, etc. We're going to take a look at everything, and then we will decide, is this stock a good buying opportunity, hold opportunity, or a sell opportunity. The stock that I'm talking about is Shopify. So let's first understand how the stock has done over the last couple of years. So if you look at the performance of the stock has pretty much gone down in this whole year. And if you look at the 1 month, the stock went down by 6.99%. In the last 6 months, it has gone down by 28%. Year to date, it has gone down by 18.58%, and 1 year it has gone down by 11.08%. But in the last 5 years, the stock has gained 80.89%. Now, this is looking at the stock performance. You probably are not optimistic. You're thinking that the stock is going down, the numbers don't add up and all of that, right? But we're going to take a look at the numbers, and then we will decide if this stock is going to be a buy for us or not. Looking at the performance, the stock is not doing very well these days. So let's take a look at the 52-week high. 52-week high is 91.57. 52-week low is 45.50. It doesn't give you a dividend. Market cap is 77.46 billion. And the first thing I'm under Shopify stock. We'll go under the fundamental charts. And the first thing we're going to look at is the revenue has gone up. Have the expenses have gone down. The other thing we're going to take a look at earnings. Then we're going to take a look at the price to sales ratio and price to earnings ratio. So far, looking at the stock, the performance is not well. But does it align with, we have to look at the stock in the forward direction, right? What this stock is going to be in the next 5 to 10 years. Does it have the potential to go up, or it is going to go down further from this point? We are going to take a look at the sales. And if I go over to the Shopify earnings, if you go over here, one of the good things that you're going to notice, if I go to the Shopify stock and earnings, you can see here in March of 2024, the revenue has gone up by 23.41%. This is a plus point for Shopify. If you go to the December, it has also gone up by 23.57. In September, it has gone up by 25.48. In June, it has gone up by 30.81. So the stock is growing. The company is growing in double digits. The revenue is growing in double digits, which is a good sign. So this is a positive sign for the stock. Net income has gone down. That's okay. Diluted EPS, which is another factor, it has gone down by 520%. This is a negative sign for the stock at the moment. We have one positive and one negative. Positive is the revenue is growing in double digits. The negative is the diluted EPS went down. Profit margin have also reduced, which is not a good thing. Operating income has gone up by 190%, and net change in cash is up by 135%. So we have some goods about the stock and some bad things about the stock. Overall, if you look at the earnings, in the last 4 quarters, they have beaten up the EPS as well as the revenue. So which is a good sign again. So we have beaten up the EPS as well as revenue in the last 4 quarters. Now let's take a look at Shopify stock. The first thing we're going to look is their sales, okay, the revenue for 12 months, okay, trailing 12 months. If you look at the revenue, if you see here, the revenue is going up significantly. You can see here at this time in the year 2023, December, it was around 7,000 millions. And over here, it has gone up from 7,000 to 7,400, okay? So these are in millions. So the revenue is growing up, which is a great sign. And we have seen that in the earnings as well, that revenue is growing by double digits. So it's a positive sign. So as per this revenue, looking at the revenue picture, the stock looks like in a good direction. The revenues are increasing. The next thing we're going to see is expenses. Do the expenses are decreasing or not? So if you go ahead and take a look at the expenses, the total expenses TTM. Total expenses TTM, which is trailing 12 months, you can see here revenue has gone up. If you look at the second metric, I'm going to pull up the revenue metric here. You can see here revenue is growing up, but the expenses have been stable. which is this graph here. The line that you see, the dotted line is the revenue line, and the line that is the solid line, which is basically going in the horizontal direction, that tells me the expenses are stable but the revenue is increasing. That is another good sign for the stock. So we have seen two good signs: the revenue is increasing as well as expenses are also under the limit. Okay. Now the next important thing we have to look at is the earnings yield. So if I go over to the earnings have dropped. So if you see here, it was around 1.6 and has gone down to about 1.4 in the last, I would say, from May of 2024 to June of 2024. So it has gone down, but that's okay. We're going to see the earnings report in the next 7, I think it'll be due August 7th or 8th. So that is there. Now the earnings per ratio earnings have gone down. So looking at this, earnings yield have gone down, which is okay, but it's still in the growing direction. It is in the up direction. So you can see here it was below. At this point in 2023, it was all the way low, but now it is in the positive direction. It is going up, and then it took a little slight dump here at 1.4. So far, we have seen 3 things. Out of the 3 things, 2 things are looking good. Revenue looks good. Expenses are under the limit. Expenses are stable. So those 2 things are good. Earnings have slightly decreased, but that's fine. Now let's take a look at, is this a good buying point to buy the stock or not? Another point before we go there is gross profit. Has the profit have increased or not? So if you see here, profit curve is also in this right direction. The profit is also increasing. The revenues are increasing as well as the profit is increasing. So we are looking at the right number so far. So far, the stock is saying that it is a good buy point right now. It is good, but we need to decide, is it an expensive stock at the moment or is it an undervalued stock? So we're going to look at 2 things: price to sales and price to earnings. So the first thing is I'm going to look at price to sales ratio here. So price to sales ratio should be less. If the price to sales ratio is less, that means the denominator, which is the sales figure, is greater. That means their sales are high. So if the PS ratio is less, that's a good sign. So if it is dropping, that's a good sign here. If you go here, you can see it went down. So it was very high, above 40 in 2022, and then it has gone down since then, and right now is it around 10.41. So looking at this, price to sales ratio has gone down from its higher. That means it is a good buying point at the moment. So this stock right now has all the right signals going out for me. And you can see here there is a huge drop from December 2021. It went down all the way. It was at 44.31 and then it went down to 23.78, and this is a good sign. And right now it is currently at 11.47. So price to sales ratio is dropping, which is a good sign. Now let's take a look at the price to earnings ratio. You can see here PE ratio. This should also not be too high. If it's too high, that means it's a very expensive stock. But if it is around the margin, if it's around the median value, then it is a good sign. Okay, but the companies which are growth companies, usually their PE ratios are in the higher numbers. Now you can see here the PE ratio has also declined drastically from 2000 it went down to 323. So that this is a good buying point right now, but we have to see what went wrong here, right? So in June it dropped in 2023, but now if you see here it is at the 64 and it is around 65.15. So you see here currently the price to earning ratio is 73. It's a little bit higher. So now based on all this analysis, what I think is the stock is reasonably priced. Okay, the sales are increasing, revenues is increasing, earnings yield have decreased a bit. Now based on all the numbers that we have seen so far, revenue, the expenses, the profit, PE ratio, PS ratios, etc., all of these tells me a story that this is a good stock to buy and hold right now. And currently this stock is reasonably priced. It's not too expensive right now. So it's good stock, good timings to buy the stock, and the stock is moving in the right direction. Eventually the stock is going to bounce back and you're going to get your profits. So I highly recommend you, and as per my analysis, I think this stock is a buy. Now, what do you think of the stock? Do let me know in the comment section. Do you think this is a buying opportunity, or do you see any problems with the stock? Do you see that I have not covered a specific thing in this video? Do let me know, so I'll make sure to cover them in the next couple of videos. So I hope you enjoyed today's video. Thank you very much and have a wonderful rest of the day. Bye-bye. Take care.